The September quarter has really been a tale of two different trends in the Australian real estate market. On the one hand, on the investment side, we've seen a lot of activity. Year to date, we've seen $12 billion worth of transactions compared to $8.2 billion over the first 9 months of last year. The other significant trend from the investment point of view has been the high level of activity of offshore investors in our domestic market. Year to date, 34% of all major transactions are accounted for by offshore investors, whereas over the same period last year we were looking at 25%. So on the investment side, there's been a lot of activity. Contrast that with what we've seen on the leasing side. There's been a definite slowdown in leasing activity. Tenants are cautious. Landlords are very keen to attract tenants. But in the commodity-driven markets, such as Perth and Brisbane, we've seen definite concern about the possibility of a slowdown in China and some softening in commodity prices, which is affecting mining and exploration companies. In Sydney and Melbourne, which are more exposed to the financial sector, we've seen some large finance houses contracting or at least putting on hold plans for expansion. This is all happening against a fairly strong economic backdrop. Over the year to June, the Australian economy expanded by 3.8%, which is above trend, and in the June quarter we saw a 0.6% expansion. That's slower than the previous quarter, but it's still a fairly robust performance. Turning to the office market, we've seen, as I mentioned, sublease space being handed back to the market in a number of cases. The overall average CBD vacancy rate rose from 7.8% in the second quarter to 8.3% in the third quarter, largely due to the increase in sublease availability. Rents have been generally flat, and there's been some tendency for incentives to rise. As a result of that, we've seen very modest capital value growth over the quarter, and the broad trend is for capital value growth to slow through the course of 2012. In the case of the retail sector, we've seen quite a strong change, I think, in sentiment. In the last update, we talked about the retail sector as the sector facing significant headwinds, and it certainly remains the case that the retail sector is facing a number of structural challenges. But if you look at retail turnover, although it's still running below trend, we're starting to see an upward trend. That's partly because interest rate cuts are starting to feed through into consumer behaviour and shoppers are becoming more confident. It's also because over the last quarter we've seen house prices stabilise and we've seen a rise in the share market, which has a positive impact on the household balance sheet. So while the retail sector remains under some pressure, it is certainly the case that the sector looks more promising than it did a few quarters ago. Investor interest remains high, and one of the trends that we've observed is that while yields on regional shopping centres have tended to tighten, we've seen the opposite trend in the case of neighbourhood shopping centres. The yield gap between the neighbourhood centres and the regional centres is currently the highest it's been for 10 years, which would suggest that either investors are becoming more cautious or there are opportunities emerging in the sub-regional and also in the neighbourhood shopping centre sector. In summary, there remains strong support for the Australian commercial real estate sector. On the supply side, the supply pipeline is very limited. That is particularly the case in the office and industrial markets. In the case of retail, there's a fairly high level of construction activity, but a good deal of this represents expansion of existing centres and refurbishment of existing centres, so it doesn't translate directly into an increase in supply. The other source of support for the Australian real estate market is the high level of yields. Although we've seen some yield compression, particularly in the case of prime assets, the yield gap between prime asset yields and bond market yields remains close to record levels. Furthermore, the gap between Australian prime yields and yields in many offshore markets is extremely wide. Given the high level of yields in the Australian commercial real estate sector, there remains a high level of comfort for investors. Within the Asia-Pacific region, Australia is the destination of preference for many international investors. Over the past 18 months, Australia has attracted around 39% of all capital inflows into the Asia-Pacific region, compared to 17% for China and 15% for Japan. Australia definitely remains the destination of preference for global investors looking to take a position in the Asia-Pacific region.